Buying municipal bonds, munis, is a classic way to earn tax-free income while supporting local infrastructure like schools and roads. In 2026, the market remains a staple for investors, particularly those in higher tax brackets looking to offset tax bills. There are three primary ways to buy them, depending on how much work you want to do. First, buying individual bonds directly. This is the most hands-on method. You buy a specific bond issued by a city or state and hold it until it matures. You can buy them through a brokerage account like Schwab, Fidelity, or Vanguard, browsing their fixed income or bond desk. These are usually sold in $5,000 increments. To build a diversified ladder of individual bonds, you typically need at least $50,000 to $100,000. The pros are, you know exactly when you'll get your principal back, and there are no ongoing management fees. The cons include low liquidity. If you need to sell before the bond matures, you might have to take a haircut on the price. Second, municipal bond ETFs and mutual funds. This is the most common route for individual investors. Instead of one bond, you buy a basket of hundreds of bonds. ETFs, or exchange-traded funds, trade like stocks throughout the day with symbols like MUB or HIMB. These are generally lower cost. Mutual funds are priced once a day. Many mutual funds offer state-specific funds, for example, a California Muni Fund, which can make the interest double tax-free if you live in that state. The pros include instant diversification and very high liquidity, meaning you can sell anytime the market is open. The cons are that you pay an annual expense ratio, or fee, and since the fund never matures, your principal value fluctuates with interest rates. Third, separately managed accounts, or SMAs. For high net worth investors, an SMA allows a professional manager to build a custom portfolio of individual bonds for you. The minimum is usually $250,000 to $500,000 or more. The pros include professional oversight and customization for your specific tax situation. Since muni interest is usually exempt from federal and sometimes state taxes, a 3.5% muni yield might be worth the same as a 5% taxable corporate bond yield. Use a TI calculator provided by your broker to compare. Some bonds are subject to the alternative minimum tax. If you are a high-income filer, look for bonds labeled AMT-free. Look for bonds rated AAAA or AAAA if you want the highest security. Revenue bonds, backed by tolls or fees, are often slightly riskier than general obligation, GO bonds, backed by the city's taxing power. Never put tax-exempt bonds in a tax-deferred account. You're already getting a tax break from the IRA, so you'd be wasting the muni's tax benefit while accepting a lower interest rate. Many munis are callable, meaning the city can pay you back early if interest rates drop. Always look at the yield to call, YTC, not just the stated interest rate. Would you like me to calculate the tax equivalent yield for a specific bond you're looking at, or explain how to set up a bond ladder? For high-income earners in 2026, municipal bonds are less of a support your local library play and more of a surgical strike on your tax bill. Because the interest is typically exempt from federal taxes, the richer you are, i.e., the higher your tax bracket, the more you benefit. Here is how the math and strategy break down for the highest earners. The tax equivalent yield advantage. The biggest benefit is that you keep 100% of the interest. To see the value, you have to compare it to a taxable corporate bond or CD using the tax equivalent yield, TEY. For an investor in the top 37% federal bracket plus the 3.8% net investment income tax, NIIT, your effective federal tax rate is 40.8%. A wealthy person in the 40.8% bracket gets a much better deal on a 4% muni bond than someone in the 12% bracket, for whom that same bond is only equivalent to a 4.5% taxable yield. High earners, single AGI over 200K, married over 250K, are hit with the 3.8% net investment income tax on capital gains, dividends, and taxable interest. Interest from municipal bonds is explicitly excluded from the NIIT calculation. It doesn't count as net investment income, protecting more of your wealth from this specific surcharge. If you live in a high-tax state like California, New York, or Massachusetts, you can buy bonds issued by your own state or local city. This means federal tax-exempt, state tax-exempt, and local city tax-exempt. For example, NYC residents buying NYC bonds. With state tax rates in some places reaching 10 to 13%, a triple tax-free bond can result in a tax-equivalent yield of nearly 9 to 10% for the ultra-wealthy. Even for the rich, there are a few ways the IRS catches up to you. The AMT trap. Some private activity muni bonds used for airports or stadiums are subject to the alternative minimum tax. If your tax profile triggers the AMT, that tax-free interest suddenly becomes taxable. Fix. Look for bonds specifically labeled AMT-free. Capital gains are not exempt. While the interest is tax-free, if you buy a bond at a discount and sell it for a profit, or if you sell a muni fund at a gain, you still owe capital gains tax. Social Security bracket creep. Even though muni interest isn't taxable, it is included in your combined income formula. For some, this can push more of their Social Security benefits into the taxable range. Instead of buying a generic muni ETF, many wealthy investors use a separately managed account, or SMA. Customization. A manager builds a portfolio of individual bonds specifically for your state of residence. Loss harvesting. If interest rates rise and bond prices fall, an SMA manager can sell loser bonds to lock in a tax loss, which offsets your other capital gains, and immediately buy a similar bond to keep your income steady.